KRC Realty here talking Monday Mortgage Mornings with Jerry Vederick. Jerry, what are we talking about today?
Let's talk about pre-qualifying for a mortgage.
Pre-qualified, let's go. Being in the real estate business, working with a lot of buyers, one of the one of the biggest things I think most realtors run into is when someone says, hey, I want to make an offer on this property, or they're reaching out to you to help them find a home. It's very important that that person is pre-qualified. And why is that?
Well, first of all, because a realtor or a seller does not want to deal with people that they don't know have the means to buy the house. All right, so in terms of sequencing, you need to be able to determine your eligibility. How do you even know how much money you're able to borrow unless you talk to the lender first and tell him, this is my background, this is my income, this is my down payment, et cetera, this is my credit background. Okay, all those factors go into a composite of what your eligibility is in terms of borrowing for a mortgage.
So there's three factors when it comes to eligibility. The first one is FICO score.
Correct.
Credit score. The second one is going to be your front end debt, and then your back end debt. And it's the back end debt that usually messes people up. What most people don't understand, you could have somebody making 80 grand a year, and they're going, oh, I qualify, I can easily make a $3,500 a month mortgage payment, and then they don't realize that their $600 a month car payment is messing up their back end debt. So the bank looks at a front end, which is typically 41%.
Yes.
And a back end of 45, 46.
Yes.
So between 41% of your mortgage can go towards, 41% can go towards housing, and the rest goes towards
all your other expenses.
So car payment, credit card debt, all that other good stuff.
Recurring debt.
And if you fall out of the numbers when it comes to,
You don't qualify.
you don't qualify. So being pre-qualified is huge because you know exactly what you qualify for, and you're not. You might be thinking you only qualify for a $500,000 house, you can go get a $650,000 house.
Well, exactly. And here's the other thing, Rich, that most people take a look and they say, well, I make X amount, $1,000 per month. All right, what does that equate to in terms of a borrowed amount of money to purchase a home? You don't have a clue. So then how do you determine what price range homes you're going to look at? How would you possibly know? Well, you have to do those things that you just said. You have to call up a lender and you say, I want you to pull my credit score. This is the income I make. This is the amount I have for a down payment. This is a spouse, this is the income. They'll be a co-borrower. We take those numbers and we do our calculation. We come back to Mr. Smith and say, this is what we can lend you. And we put it in a letter. That letter you can show to a realtor or a seller and say, you see, these are my bona fides. I can buy this house, and this is the amount of money XYZ will lend me. Really important to have that sequence right.
It is. And if you do get pre-qualified, always remember the only thing a mortgage broker can charge, any lender can charge you for, is a credit report. There's no such thing as upfront fees. Anyone charging you an upfront fee, application fee, run as fast as you can or give us a call. The only thing they can charge you for is to run your credit. That typically runs 40 to 50 bucks, something like that. So they legally can charge you for that, but if anyone is saying, hey, we need to collect an application fee or any other type of fee, that is a huge violation under the NMLS, and they cannot do that. So, yeah.
And the other thing I would point out to all your listeners is this, that if you are disappointed in what your credit report says, by taking steps before you actually go out and try and buy something to repair your credit will maybe boost you up to a cheaper borrowing rate because you were able to work on it for a week or two before you wanted to go out and buy a home. And it's so important. You take care of yourself. It costs you nothing. As Rich says, it costs you absolutely nothing to have that done.
Yeah. One good thing, that's actually an interesting part. One thing I learned early on in the mortgage business was I had a client that they had like a $500, it was just a $500 credit card, but it was pretty much maxed out. They paid the credit card off, and then they closed out the account, which was the worst thing they ever could have done.
Right.
Because the minute you close out that account, you would have been better off showing the lender that you had $500 available credit to you that you weren't utilizing. It makes you look stronger as opposed to
zero balance.
Zero balance
looks.
looks.
You kept the account open.
And that'll that'll boost your
FICO score.
your FICO score 5, 10, 15 points easily.
And the higher the FICO score is a beauty contest. The higher your FICO, the cheaper you can borrow.
Great. Any questions about pre-qualifying? Give us a call. Information is down below. Rich Farmer with KRC Realty. Love to help you out.